Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourself, Banking and General Knowledge, etc. Today I will discuss interview questions and answers related to the internal promotion examination for banks. Welcome to part 27 of my Path to the Corner Office 2025-2026 series, where I simplify bank promotion examination interviews with practical questions and answers, examples to help you climb the banking career ladder faster. Interview questions and answers from Asset Liability Management (ALM). Question: what is Asset Liability Management (ALM)? Answer: ALM is a strategic framework for managing the risks arising from mismatches between a bank's assets and liabilities, primarily focusing on interest rate risk, liquidity risk, and funding risk. Question: what are the main objectives of ALM? Answer: to ensure liquidity, manage interest rate risk, optimize the risk-return profile, and ensure the bank's long-term solvency and profitability. Question: what is the difference between asset liability management and fund management? Answer: fund management focuses only on investing surplus funds, whereas ALM manages both assets and liabilities to control risk and ensure stability. Question: what are the key risks managed under ALM? Answer: interest rate risk, liquidity risk, foreign exchange risk, and credit risk indirectly through funding strategies. What is the significance of ALM in a bank? Answer: ALM helps in maintaining balance sheet stability, ensuring sufficient liquidity, and mitigating risks from interest rate fluctuations or maturity mismatches. Question: what is interest rate risk? IRR. Answer: IRR is the potential for financial loss due to changes in market interest rates affecting a bank's assets and liabilities differently. Question: what is the gap analysis in ALM? Answer: gap analysis measures the difference between rate sensitive assets and rate sensitive liabilities over different time brackets to identify exposure to interest rate changes. Question: what is a positive gap? Answer: a positive gap occurs when rate-sensitive assets exceed rate-sensitive liabilities, leading to higher profits if interest rates rise. What is a negative gap? Answer: a negative gap occurs when rate-sensitive liabilities exceed rate-sensitive assets, leading to losses if interest rates rise. Question: how does ALM help in managing interest rate risk? Answer: by using gap analysis, duration analysis, and hedging instruments like derivatives to match assets and liabilities interest rate sensitivity. Question: what is duration analysis? Answer: duration analysis measures the weighted average time to receive cash flows and the sensitivity of the bank's assets and liabilities to interest rate changes. Question: what is the difference between gap analysis and duration analysis? Answer: gap analysis measures exposure in discrete time buckets, whereas duration analysis measures interest rate sensitivity continuously and considers the timing of cash flows. Question: what is liquidity risk? Answer: the risk that a bank cannot meet its financial obligations when they come due without incurring unacceptable losses. Question: what are the sources of liquidity risks? Answer: unexpected withdrawals, loan demand, market disruptions, or funding mismatches. Question: how is liquidity risk measured? Answer: through liquidity ratios like LCR, liquidity coverage ratio, NSFR, net stable funding ratio, and cash flow projections. Question: what is LCR? Answer: the liquidity coverage ratio ensures a bank maintains sufficient high quality liquid risk assets to survive a 30-day stress scenario. Question: what is NSFR? Answer: the net stable funding ratio measures the stability of a bank's funding over a 1 year horizon, promoting long-term liquidity stability. Question: how does ALM address liquidity risks? Answer: by monitoring cash flow mismatches, maintaining liquid assets, and planning for contingent funding sources. Question. What is a liquidity gap? Answer. The difference between expected inflows and outflows in various time buckets. It helps identify periods of potential liquidity stress. Question. What is the role of stress testing in ALM? Answer. Stress testing stimulates adverse scenarios to evaluate the bank's resilience to liquidity or interest rate shocks. Question. How does ALM handle foreign exchange risk? Answer. By monitoring net open positions using hedging instruments like forwards and swaps and aligning foreign currency assets and liabilities. Question. What is a currency gap? Answer. The difference between foreign currency assets and liabilities in a bank's balance sheet, exposing it to FX function fluctuations. Question. What is market risk in ALM context? Answer. Risk of loss due to changes in market rates, interest, currency, equity, affecting the value of assets and liabilities. Question. Which regulatory guidelines govern ALM in India? Answer. RBI guidelines under Master Circular on ALM, including prudential norms for interest rate risk, and liquidity coverage. Question. What is CRR and SLR in ALM? Answer. Cash reserve ratio, CRR, and statutory liquidity ratio, SLR, are regulatory requirements affecting liquidity and funds deployment. Question. What is the role of ALM in Basel III norms? Answer. ALM ensures compliance with liquidity ratios, LCR, NSFR, capital adequacy, and interest rate risk management under Basel III. Question. What is the ALM committee? Answer. A senior management committee in a bank responsible for monitoring, reviewing, and controlling ALM risks and policies. Question. What is the scope of ALM under RBI guidelines? Answer. Managing interest rate risk, liquidity risk, currency risk, maturity mismatches, and implementing internal risk limits. Question. How often should a bank prepare an ALM report? Answer. Typically monthly or quarterly for senior management review, but liquidity reports are often daily. Question. What are the common ALM tools? Answer. Gap analysis, US analysis, simulation models, stress testing, interest rate swaps, and currency hedges. Question. What is a funding gap? Answer. The difference between liabilities maturing and assets maturing in a time bucket, highlighting funding needs. Question. What is the difference between structural and dynamic ALM? Answer. Structural ALM focuses on long-term risk like interest rate mismatches. Dynamic ALM focuses on short-term liquidity and funding management. Question. What is cash flow matching in ALM? Answer. Aligning cash flows from assets with cash outflows of liabilities to ensure liquidity at all times. Question. What is stress testing in ALM? Answer is simulating extreme but plausible scenarios, interest rate shocks, deposit withdrawals to assess bank resilience. Question. What is the importance of interest rate sensitivity gap? Answer. It identifies periods when changes in interest rates could significantly impact the bank's net interest income. Question. How is ALM linked to profitability? Answer. Proper ALM ensures stable net interest income, minimizes risk-related losses, and optimizes the risk-return balance. Question. What is the difference between on-balance sheet and off-balance sheet ALM? Answer. On-balance sheet ALM deals with assets and liabilities in the balance sheet. Off-balance sheet ALM deals with derivatives, guarantees, and contingent exposures. Question. What is a derivative instrument used in ALM? Answer. Interest rate swaps, forward rate agreements, currency swaps, and options are used to hedge ALM risks. Question. What is the role of liquidity contingency planning in ALM? To ensure predefined measures are in place to handle unexpected liquidity shortfalls. Question. What is earnings at risk? EAR. EAR measures the potential reduction in the net interest income due to adverse interest rate movements over a specified horizon. Question. What is economic value of equity (EV) in ALM? EVE measures to sensitivity of banks' net worth changes in interest rates, assessing long-term risk. Question. How do you calculate the interest rate gap? Answer. Interest rate gap is equal to rate sensitive assets minus rate sensitive liabilities for a specific time bracket. Question. What is the difference between liquidity gap and interest rate gap? Answer. Liquidity gap focuses on cash flow mismatches, while interest rate gap focuses on exposure to interest rate changes. Question. What are the time buckets in ALM reporting? Answer. Common buckets: overnight 1 to 7 days, 8 to 14 days, 15 to 30 days, 1 to 3 months, 3 to 6 months, 6 to 12 months, 1 to 3 years, 3 to 5 years, and more than 5 years. Question. How is ALM integrated with capital planning? Answer. ALM helps ensure sufficient liquidity and interest rate buffers, influencing capital allocation and adequacy planning. Question. What is the difference between static and dynamic gap analysis? Answer. Static assumes no changes in balance sheet composition. Dynamic considers future changes in assets, liabilities under planned scenarios. Question. How does ALM affect bank ratings? Answer. Strong ALM practices reduce risk exposure, improving liquidity and profitability metrics, positively impacting credit ratings. Question. What is the role of ALM in risk-based pricing of loans? Answer. ALM assesses funding costs, interest rate sensitivity, and liquidity constraints influencing lending rates. Question. What are the key reports generated by ALM? Answer. Interest rate gap report, liquidity gap report, EAR report, EVE report, and stress test results. Question. What is the future trend in ALM for banks? Answer. Greater use of predictive analytics, integrated risk management, real-time liquidity monitoring, and regulatory compliance automation. Thank you very much for your patience. Request for like, subscribe, and share.